Imagine cutting your operating budget, paying off, I don't know, $41 million in corporate debt, but somehow somehow simultaneously growing your underlying profit by like 76%.
It's wild.
It is. On paper, it almost sounds like, well, illegal accounting.
Oh, totally.
It sounds like financial magic.
Yeah.
Because usually when you hear a company talk about, aggressively cutting their costs, there's this underlying expectation of distress.
Yeah. You assume things are bad.
Exactly. It's like watching someone furiously patch a leaky boat with duct tape. You just assume they're frantically bailing water.
Right. Yeah.
The company shrinks their expenses just to survive, but inevitably, they shrink their ability to grow right along with it.
That is the classic corporate diet right there. You starve the business of capital, you stop investing in your
research and development.
Exactly, your R&D. You lay off half the sales team, and yes, your quarterly expenses go down.
And Wall Street claps for a minute.
Wall Street might even clap, yeah. But so does your ability to actually generate new revenue.
Right.
It is fundamentally a defensive maneuver. It's retreating. And you rarely win a war by retreating.
Which brings us to a massive paradox. Welcome back to Talk Tickers. This is our data forward format where we take a magnifying glass to corporate earnings calls, specifically for you, the retail investor.
That's right.
Our mission is always the same. We deliver the hard data, we translate the Wall Street jargon so it actually makes sense, and we give you an opinionated, actionable take on what these results mean for your portfolio.
The stuff that actually matters.
Exactly. Now, normally we try to compress these into a rapid-fire format, but today we are throwing that entire playbook out the window.
Yeah, we have to.
We're unpacking the Q3 fiscal 2026 earnings call for Digital Turbine Incorporated. Ticker symbol is APPS. And frankly, there is simply too much structural transformation happening beneath the surface here to rush it.
Way too much.
So grab a coffee, settle in, because we are going deep into the mechanics of a turnaround today.
And turnaround is definitely the operative word here. It's the core theme of this specific deep dive is a massive systemic transformation.
Right.
What we're looking at in these transcript pages is Digital Turbine shifting away from being this highly leveraged, debt-heavy tech play.
Which, let's be honest, carries a massive amount of risk for any retail investor.
A huge risk. But they're shifting from that into a lean, highly profitable operator that is actively outgrowing its largest competitors in the ad tech space.
Impressive.
It really is. This isn't just a story about surviving a tough macroeconomic environment where, advertising budgets are tight. It's about fundamentally rewiring how their specific technology generates cash.
Okay, I want to start by putting you on the spot regarding the headline numbers, actually.
Okay, let's do it.
I was looking at the trading terminals when this report dropped, and I saw the top line revenue hit $151.4 million for the December quarter.
Right.
Now, that represents a 12% year-over-year growth. In today's ad tech environment, 12% is, well, it's solid.
It's respectable for sure.
Yeah. Right, but it doesn't necessarily explain the massive shift in narrative.
Yeah.
So break down the actual profitability metrics for me here. What is happening beneath that $151 million revenue figure?
Well, the revenue is really just the tip of the iceberg. To understand the real story, we have to look at the bottom line.
Okay.
The non-GAAP earnings per share, or EPS, came in at 18 cents, which was generated on $21.7 million of non-GAAP net income.
Stop right there for a second. We promise to translate the jargon for you, the listener. Whenever earnings season rolls around, we constantly see companies reporting GAAP and non-GAAP numbers.
All the time.
What is the actual difference, and why should a retail investor care about the non-GAAP figure here?
It's a vital distinction. So GAAP stands for Generally Accepted Accounting Principles.
Right.
It's the standardized, rigid set of rules that the government and regulators require every public company to follow.
Right.
It includes absolutely everything. One-time restructuring costs, legal settlements, and massive non-cash expenses like stock-based compensation for employees.
So it's basically the raw, unfiltered, legally required math.
Exactly. But non-GAAP is essentially the management team saying, hey, if you strip out all the weird one-time accounting anomalies and the non-cash expenses, here is how the actual day-to-day core business performed. Wall Street often prefers non-GAAP because it gives a clearer picture of the ongoing operational health of the company. It just removes the noise.
That makes sense.
So generating $21.7 million in non-GAAP net income means the core engine of Digital Turbine is highly profitable. But honestly, even that isn't the most important number in this transcript. No. The real showstopper, the metric that completely changes the valuation model for this company, is their adjusted EBITDA.
Earnings before interest, taxes, depreciation, and amortization.
Correct. For a tech company that has historically made acquisitions, they often have a lot of depreciation and amortization on the books, which are really just accounting ghosts.
Right, non-cash stuff.
Exactly. EBITDA strips those ghosts away and shows you the pure operational cash flow the business is generating before the taxman and the banks take their cut.
Okay.
Digital Turbine's adjusted EBITDA hit nearly $39 million for the quarter.
Okay, $39 million. Put that into historical context for me. How much of a jump is that, actually?
Well, remember how you just said their top-line revenue grew by 12%?
Right.
Well, that adjusted EBITDA number shot up by an astounding 76% year over year.
Wait, 76%?
Yep.
That's the paradox I mentioned at the top of the show. Walk me through the mechanics of that. How is it mathematically possible for a company to only grow its sales by 12%, but grow its actual underlying profit by 76%?
It's the absolute definition of operating leverage.
Okay.
Let me put it in terms of margin expansion. Their EBITDA margins expanded to 26% of total revenue.
Wow.
And to put that in context, management explicitly noted on the call that this marks their 7th consecutive quarter of margin growth. 7th. This isn't a fluke. It's a sustained, intentional trend. It's an improvement of over 900 basis points versus the prior year.
Just to translate that for our listeners, 900 basis points is a massive 9 full percentage points of margin improvement.
Yes. Furthermore, their non-GAAP gross margins jumped to 49% from 44% a year ago.
That is huge.
In the software distribution and ad tech space, jumping your gross margin by 5 full percentage points in a single year is a structural earthquake.
Yeah, I'd imagine.
It means the core cost of delivering their product has fundamentally cheapened, or they are commanding a much higher premium price for it. And in this case, it's actually a bit of both.
I need an analogy to wrap my head around this, because seeing profit grow 6 times faster than revenue kind of breaks the standard mental model of business growth.
It really does.
Think of it like, I don't know, a local restaurant.
Okay, I like that.
Let's say a restaurant serves 10% more customers this year than they did last year. That's the 12% revenue growth. It's good, steady foot traffic. But at the end of the night, when the owner counts the physical cash in the till, they are keeping 75% more money than they did the year before.
Exactly.
How does a restaurant pull that off? They don't do it just by serving more burgers. They do it because they finally stopped over-ordering expensive ingredients that were, spoiling in the fridge.
Wasted overhead.
Right. They optimized the kitchen staff so they aren't paying overtime. They figured out how to turn tables over in 45 minutes instead of an hour. The efficiency of the operation has fundamentally leveled up.
Yep.
It is no longer just a story about getting more customers to the door. It's about ruthlessly extracting drastically more money off every single customer that sits down.
That restaurant analogy perfectly captures the dynamic. Wall Street can sometimes get, blindingly obsessed with pure top-line revenue growth.
Oh, constantly.
Analysts are constantly asking, is the revenue growing 30%? 40%. Yeah. But if a tech company is burning through piles of venture capital cash, running massive server deficits, and spending $2 to acquire $1 of revenue, it's a completely hollow victory.
We saw that throughout the whole zero interest rate tech bubble.
Exactly. Growth at all costs. What Digital Turbine is proving right now is that you can have moderate, healthy 12% top-line growth while absolutely supercharging the bottom-line profitability.
But that brings us to the real mystery, I think. When I see a 76% profit jump, my immediate reaction is a healthy dose of skepticism.
As it should be.
You have to wonder if they sold off a division or if there's some one-off accounting trick masking the reality.
Sure.
But digging into the transcript, it seems this was entirely operational. So how do they actually pull off this massive margin expansion? What is the technological story behind these financial spreadsheets?
You're right to be skeptical, but the transcript reveals this was driven by a dual-engine strategy.
Okay, what are the engines?
Engine 1 is international growth, and Engine 2 is ruthless, technology-driven cost-cutting.
Let's start with the first engine then.
Digital Turbine operates a segment they call On-Device Solutions, or ODS. This segment generated nearly $100 million in revenue this quarter, which was up about 9% year over year.
And what exactly falls under On-Device Solutions? Like, for a retail investor who is hearing about this company for the first time today, what is the actual product?
This is where we really need to explain Ignite.
Right. I saw that all over the transcript.
Ignite is Digital Turbine's core proprietary software. Unlike an app like Uber or Spotify that you have to actively go to an app store and download, Ignite is technology that gets pre-installed on mobile phones at the factory level, or the carrier level.
Okay, so it's already there.
Yes. Digital Turbine has deep strategic partnerships with massive telecom carriers. Think Verizon, AT&T, or, international equivalents and original equipment manufacturers, the OEMs like Samsung or Motorola.
So the software is essentially baked into the phone before I even take it out of the box.
Exactly. Ignite allows for other applications to be smoothly delivered and installed on your phone right out of the box, or even dynamically over the life of the device.
Oh, wow.
If you buy a new Android phone, power it on, and suddenly you have an option to install a bundle of recommended games or utility apps during the setup process, there is a very high probability that Digital Turbine's Ignite software is powering that exact experience.
That makes total sense.
It is a monumental strategic advantage because they own the prime real estate. They are the toll booth on the device itself, rather than fighting to grab your attention through a banner ad on a mobile web browser somewhere.
Right. It's infrastructure, not just advertising.
Yeah.
So how does that tie into the international growth engine you mentioned?
On the call, management highlighted a major milestone. For the first time in the company's entire history, over 30% of those Ignite platform revenues came from outside the United States.
That's a huge shift.
It is. Furthermore, international devices and revenue per device, which they abbreviate as RPD, both grew by more than 20%.
I want to pause on that acronym, RPD, revenue per device.
Sure.
Growing international device count makes sense, right? They sign a deal with a telecom in Europe or Latin America, and suddenly Ignite is on millions of new phones.
Yep. Simple volume growth.
But growing the revenue per device internationally is notoriously difficult. Historically, the American consumer has the highest disposable income, so advertisers pay a massive premium to reach U.S. phones.
Correct.
International phones usually generate pennies on the dollar by comparison. How are they simultaneously growing the raw number of devices and making more money off each individual device?
It comes down to software optimization and better advertiser targeting.
Okay, how so?
As they gather more data on how international users engage with their devices, they can serve much more relevant app recommendations. If they put a highly targeted, high-converting game in front of a user in Brazil or Germany, the game developer is actually willing to pay a higher premium for that install.
Because it's guaranteed to be a good fit.
Exactly. They're expanding the size of the pie by adding more phones, but they're also taking a bigger slice of it by improving the efficiency of the software on those phones. This drove more than 60% year-over-year international growth for that specific segment.
Which is absolutely crucial for the long-term thesis. We all know the U.S. mobile smartphone market is totally saturated.
Oh, completely.
Everyone who wants a smartphone already has one. The upgrade cycles are lengthening too. Like people are holding onto their phones for 3 or 4 years instead of 2.
Yeah, there's no reason to upgrade as often.
Exactly. If a mobile-centric company only relies on the U.S. market for growth, they're essentially fighting over a shrinking pool of new activations.
Right.
By successfully cracking the international market and pushing that revenue mix over the 30% threshold, Digital Turbine is proving they have a viable, highly scalable growth vector that isn't tethered exclusively to the whims of the American consumer.
Precisely. The geographic diversification massively de-risks the entire revenue stream. But, as impressive as the top-line international growth is, it doesn't fully explain the 76% jump in profit.
Right, there's a gap there.
And that brings us to the second engine. The cost cutting.
And this is exactly where I really want to push back. I read the transcript line by line. On the call, CEO Bill Stone spent a significant amount of time talking about their improving use of artificial intelligence and machine learning tools.
He did.
He explicitly claimed they are using AI not just in their ad targeting algorithms, but internally for operations.
Right, for efficiency.
Yeah, he cited using AI to improve efficiency in software coding, quality assurance, regression timelines, and administrative tasks. Now, look, You and I dissect a dozen earnings transcripts every single week.
We do.
Every single CEO on the planet right now, from tech companies to fast food chains, slaps the letters A and I onto their earnings script to sound trendy to Wall Street algorithms.
It's the ultimate buzzword bingo right now.
It really is. So I have to ask you, is this actually doing anything for the bottom line here? Or is this just corporate theater to pop the stock price?
It is an incredibly fair challenge. I mean, the AI washing of corporate America is rampant right now. Companies are claiming AI integration when all they did was, buy a few ChatGPT licenses for their marketing team.
Exactly.
But as an investor, you have to look past the buzzwords and verify the claims on the cash flow statement. In this specific transcript, the chief financial officer, Steve Lasher, provided the exact verifiable data point that validates the CEO's claim.
Okay, what was it?
He noted that total cash operating expenses for the quarter were $36 million. That is actually down 4% year over year.
But couldn't a 4% drop in expenses just mean they quietly laid off a bunch of human workers to save cash?
That's a common assumption, sure.
How do we know AI is actually replacing that labor efficiently and not just burning out the remaining staff who are now doing twice the work?
Because of the corresponding revenue growth. Let's connect this to the fundamental mechanics of a software business.
Okay, lay it out.
In a normal business environment, if you are growing your top-line revenue by 12%, your operating expenses almost universally have to go up.
Right, it costs money to make money.
Exactly. You need to provision more cloud server space. You need to hire more customer support staff to handle the new international users. You need more account managers to handle the new ad campaigns. But Digital Turbine grew their top line by double digits while simultaneously shrinking their cash operating expenses.
And you're saying that disconnect is the actual proof of the AI?
Yes. Let's look at the specific example the CEO gave, regression testing timelines.
Okay, what is that?
In software development, regression testing is the painstaking process of verifying that a new update to your software didn't accidentally break existing features.
Got it. Sounds tedious.
It is. And for a company like Digital Turbine, whose software sits on thousands of different Android device models across dozens of different carriers globally, regression testing is a nightmare.
I can imagine.
Historically, you would need armies of human QA testers manually running protocols. By deploying AI to automate and accelerate those testing timelines, they can release better software faster, with fewer human hours required.
So they aren't just firing people to save a buck. They are fundamentally changing the speed at which their engineers can operate.
Exactly. The CEO noted that their total profit dollars increased by more than 25%, while operating expenses declined.
That's incredible.
That mathematical divergence only happens when technology is actively doing the heavy lifting that human capital used to do. It means the AI integration is real, and it is actively defending their profit margins.
I love that. The proof isn't in the press release. The proof is in the shrinking OpEx line item on the spreadsheet.
Always follow the numbers.
So we have international growth expanding the top line, and genuine AI-driven operational efficiency squeezing maximum profit out of the bottom line.
Yeah, those are the two engines.
But as fascinating as that is, there's a third catalyst buried in this transcript. And honestly, for a retail investor looking at the long-term 5-year thesis on this stock, this might be the most disruptive and exciting piece of technology they have.
I know exactly where you're going.
I want to spend some serious time on what they call SingleTap.
We absolutely should, because SingleTap is arguably the crown jewel of Digital Turbine's entire technological portfolio. This is the technology that transitions them from being just an ad network into being a structural piece of the mobile economy's infrastructure.
Management announced on this earnings call that they signed 3 of the largest global mobile game developers in the world to use their SingleTap capability in the December quarter.
Yes, massive developers.
What's even wilder is that they confirmed these massive developers are already live and generating revenue. But before we get into the financial impact, we need to translate the mechanism for the listener.
Okay, let's break it down.
Walk me through the actual user experience. If I am holding my Android phone right now and I see an ad for a game, what happens?
To understand the immense value of SingleTap, you first have to understand the immense friction of the current mobile app economy. Let's walk through the standard user journey today.
Okay, picture it.
You're scrolling through a news app, and you see a compelling video ad for a new mobile game. You tap the ad.
Right.
Instantly, you are ripped out of the news app, and your phone redirects you to the Google Play Store or the Apple App Store.
Annoying, but standard.
Right. You have to wait for the store page to load. Then you have to click the download button. Depending on your security settings, you might have to authenticate the download with facial recognition, a fingerprint, or type in your password.
Right.
Then you wait for the massive file to download and install. Finally, you have to find the icon on your home screen and open the game.
Just listening to you list those steps feels exhausting.
It is. Every single one of those steps is a friction point. And in the world of digital advertising, friction equals death. At every step, the redirects, the loading screen, the password prompt, a percentage of users will get distracted, lose interest, and abandon the download entirely. Game developers spend millions of dollars on beautiful ads, only to lose the customer in the convoluted maze of the App Store download process.
Okay, I want to try a different analogy here.
Go for it.
Think of the Apple App Store or the Google Play Store, like a massive mandatory toll bridge that every single developer is forced to drive their customers across.
Well, I like this.
It's crowded, there's traffic, you have to stop and show your ID, and worst of all, the troll under the bridge demands a massive cut of your money. It's an awful experience, but for the last decade, it was the only way to cross the river.
Very true.
So what is SingleTap doing differently?
SingleTap is the equivalent of building a high-speed, private, underground tunnel that completely bypasses the toll bridge entirely.
Oh, wow.
If a game developer is utilizing SingleTap, the user experience changes drastically. You see the ad for the game while scrolling your news app, you tap the ad, and, well, that's it.
What do you mean that's it?
One tap. A small prompt might appear asking to confirm the install, and then the game simply begins downloading and installing seamlessly in the background while you continue reading your news article.
No way.
Yes. There is no forced redirect to the Google Play Store. There is no secondary loading screen. It massively, almost unfathomably, increases the conversion rate from an initial ad click to a fully installed, playable game on the device.
Because you don't lose them in the maze.
Exactly. Advertisers and game developers love it because it ensures that their expensive advertising spend actually results in acquired users rather than users who just get frustrated and quit.
Wait, I need to understand the mechanism here. How is Digital Turbine allowed to do that? If I click a random link on my phone, Android forces me to the Play Store specifically for security reasons.
Right.
Google doesn't want malicious software downloading in the background. How is Digital Turbine able to just bypass Google's security wall?
This goes back exactly to what we discussed earlier with the Ignite platform.
The factory install.
Because Digital Turbine partners directly with the telecom carriers and the phone manufacturers, their Ignite software is integrated at the firmware level. It has system-level privileges that a standard app simply does not have.
So the phone already trusts it.
The phone trusts the Ignite software inherently because the carrier put it there. SingleTap utilizes that underlying trusted Ignite infrastructure to facilitate the secure background download.
That is brilliant.
It is a technological moat that is incredibly difficult for a competitor to replicate because a competitor would have to go negotiate individual contracts with every major telecom carrier on Earth to get that same system-level access.
That is fascinating. The infrastructure advantage is the secret sauce. But, the narrative in this specific earnings call went even deeper than just frictionless game downloads.
Yes, it did.
The CEO talked about these massive game developers using SingleTap for something called dual downloads. And this is the part of the transcript that should make every tech investor's ears perk up. Walk me through what a dual download actually is.
A dual download is exactly what it sounds like. With a single tap on an ad, the user downloads the mobile game, but simultaneously in the background, it also downloads a secondary application.
Okay.
Specifically, the CEO explained that these developers are using SingleTap to distribute alternative applications with their own independent billing systems.
The billing systems.
Yeah.
This is where the story gets massive. Let's contextualize this for the listener, because this touches on the biggest regulatory battle in the entire technology sector right now.
Exactly. We are talking about the 30% App Store tax.
Yep.
For over a decade, Apple and Google have operated an impenetrable duopoly. If a developer wanted to sell a digital sword or extra lives or a monthly subscription inside their mobile game, Apple and Google mandated that the transaction must go through their proprietary payment processing systems.
Right, their toll booth.
And for that privilege, they take a 30% cut of the revenue. It is a massive, multi-billion-dollar pain point for global game developers. You have companies like Epic Games, the makers of Fortnite, spending hundreds of millions of dollars suing Apple and Google trying to break this monopoly.
And it's not just companies. Governments in the European Union, through the Digital Markets Act, and regulators in the US are actively trying to force Apple and Google to allow alternative app stores and third-party billing.
Right. So the entire global developer community is absolutely desperate for an escape hatch. They are starving for a way to distribute their game and process their own payments without handing 30% of their top-line revenue to Tim Cook or Sundar Pichai.
And that is exactly what Digital Turbine is offering them.
Yes, it is.
By enabling dual downloads through SingleTap, they are providing a frictionless technological escape hatch.
A literal bypass road.
A user sees an ad for a game and taps it. The game installs. But behind the scenes, the developer's proprietary billing store or alternative app store also installs. So when that user is playing the game a week later and decides to spend $20 on a cosmetic upgrade, that transaction is pre-wired to process through the developer's own billing system. Apple and Google are completely bypassed.
And the developer keeps 100% of the revenue.
It is revolutionary when you really sit back and think about the implications. They aren't fighting Apple and Google in the Supreme Court. They are just quietly building the technological bypass road.
And it's no wonder the Wall Street analysts homed in on this during the Q&A portion of the call. Tony from Craig-Hallum specifically asked about the timeline for this technology.
Yeah, I saw that. And the CEO's response was the mic drop moment. He confirmed they are live today.
Right. This isn't some theoretical white paper roadmap for the year 2028. This is technology that is currently in the market. It is actively generating revenue today, and it is actively helping 3 of the largest gaming studios on the planet bypass the traditional app store monopolies.
That reality completely reframes the investment narrative around Digital Turbine.
It does. It fundamentally elevates them. They are no longer just a clever ad tech network trying to sell banner ads. They are positioning themselves as a fundamental, critical piece of infrastructure in a rapidly decentralizing mobile ecosystem.
As regulatory pressure mounts globally, the walled gardens of Apple and Google are starting to show cracks.
Definitely.
The market needs alternative distribution methods that actually work.
Oh.
Digital Turbine is sitting there with a proven, frictionless technology that is already installed on hundreds of millions of devices globally, solving that exact multi-billion-dollar problem.
And this brings us perfectly to the next section of our analysis. Because everything we have discussed so far, the Q3 financial results, the AI cost-cutting, the launch of SingleTap dual downloads, that is all in the rearview mirror.
Right, it's historical data.
But as an investor, you aren't buying the past. The stock market is a forward-looking mechanism. Wall Street doesn't care what you did yesterday. It only cares about the cash flow you're going to generate tomorrow. So let's transition to the management guidance. What is this executive team signaling about the future?
This is where the sheer confidence of the management team really shines through the transcript. Because they didn't just beat Wall Street's expectations for the quarter. They actively, aggressively raised their financial outlook for the full fiscal year 2026.
They really did.
Let me lay out the revised numbers for you.
Yep.
Management raised their full year revenue expectation to be between $553 million and $558 million.
Okay.
That represents a $10 million bump from their previous guidance. That's solid. But here's the kicker, and this is the math that I want you to explain to me.
All right.
They raised their full-year adjusted EBITDA guidance, their profit expectation, to be between $114 million and $117 million. That is a $13 million bump from their previous outlook.
I want the listener to really sit with those two numbers for a second, because if we connect this back to the entire thesis of operating leverage that we discussed at the very beginning of this deep dive, this is the ultimate undeniable proof. Management raised their revenue expectation by $10 million, but they raised their profit expectation by $13 million.
It honestly sounds like a typo in the press release. How is it mathematically possible to tell Wall Street, we expect to make $10 million more in sales, but we expect to keep $13 million more in profit?
It sounds impossible, but it is the hallmark of a perfectly optimized software business.
Explain that.
It means that because of all the initiatives we just explored, the ruthless AI-driven cost-cutting, the international expansion with higher revenue per device, the margin improvements, the business is now operating so cleanly that essentially every single new dollar of revenue they expect to bring in is flowing directly to the bottom line as pure profit. Plus, on top of that new revenue, they're continuing to find even more internal cost savings.
Let me go back to my restaurant analogy.
Oh, please do.
It's like the restaurant owner telling his investors, hey, we're going to sell an extra $1,000 worth of burgers next week, but my profit is going to go up by $1,300. It means those new customers are essentially costing the restaurant nothing to serve because the kitchen is already running, the staff is already paid, and the ingredients are already bought. And simultaneously, the owner successfully renegotiated the building's rent down by $300.
That is exactly right. Their fixed overhead costs are completely covered. The engine is running at maximum efficiency, meaning any incremental top-line growth falls straight to the bottom line. It completely justifies the intensely bullish tone of the management team on the call.
Absolutely. But there is another massive piece of the forward-looking puzzle here. Generating all this incredible tax-positive cash flow leads directly into a data point that should be absolute music to the ears of any risk-averse retail investor.
Oh, yes.
I am talking about the balance sheet cleanup.
We have to talk about the debt. Historically, if you read the bearish reports on Digital Turbine, the massive debt load was always the primary knock against the stock. It was the main reason the stock faced such intense downward pressure over the last couple of years. During the tech boom, when interest rates were practically zero, loading up on cheap debt to make aggressive acquisitions was standard operating procedure for tech companies.
Money was free.
Right, money was free. But when the Federal Reserve aggressively hiked interest rates to fight inflation, that cheap debt suddenly became a massive, expensive anchor around the company's neck.
Exactly. A high debt load in a high interest rate environment severely limits a company's strategic flexibility. Instead of taking your cash flow and hiring more engineers to build out SingleTap, a huge chunk of your cash is just going to pay the monthly interest to the banks.
It stifles innovation.
But on this call, the CFO noted something remarkable. He stated that the company paid down more than $41 million in debt just during this single quarter.
$41 million in a single 3-month period. That is a massive chunk of principal to retire. And because of that aggressive paydown, the CEO proudly stated that their debt leverage ratio now stands at roughly 3 turns, which is down from more than 5 turns just a year ago.
Stop right there. Turns of leverage. When Wall Street analysts use that phrase, my eyes instantly glaze over.
I don't blame you.
What exactly is a turn of leverage, and why is the drop from 5 to 3 so critical?
A turn is just Wall Street slang for a multiple of a company's EBITDA. It is the ratio of total debt to annual profit.
Okay.
So if a company generates $100 million in EBITDA for the year, and they have $300 million in total debt, Wall Street says they have 3 turns of leverage. Their debt is 3 times their profit.
Okay, that is beautifully simple. So a year ago, they were over 5 turns.
Yes. And 5 turns of leverage is universally considered the danger zone for a technology company.
Okay.
That is the threshold where credit rating agencies start issuing downgrades, where banks get extremely nervous about lending more money, and where institutional investors start heading for the exits.
Oh, wow.
Because if there's a sudden economic downturn or a recession hits and advertising budgets dry up, a company with 5 times leverage might physically struggle to generate enough cash to make their mandatory debt payments. They risk default.
Getting that leverage ratio down from 5 turns to 3 turns and doing it that rapidly, massively, fundamentally de-risks the entire investment thesis for this stock.
It does. 3 turns is manageable. It shows profound financial discipline from the executive team. They aren't taking their newfound AI-driven profits and throwing a massive corporate party or buying flashy new office buildings. They are aggressively repairing the roof while the sun is shining.
I love that.
And because they have generated such strong free cash flow to pay down this debt, management made another announcement on this call that is arguably the most shareholder-friendly move an executive team can possibly make.
The ATM program. Let's dig into this because this is crucial for the retail investor to understand. The CFO announced they have completely and abruptly terminated their at-the-market equity program.
Yes.
Now, if you're a retail investor listening to this, you need to understand what an ATM program actually is, how it works mechanically, and why you generally despise them as a shareholder.
An at-the-market offering is a financial mechanism that allows a publicly traded company to slowly create new shares of stock entirely out of thin air and sell those newly minted shares directly onto the open market at the current trading price to raise cash.
It is the literal definition of dilution, pure and simple. Think of the total value of Digital Turbine as a single pizza.
Right.
If you own 100 shares, you own a specific slice of that pizza. But every time the company uses an ATM program to sell newly created shares, they are cutting the pizza into smaller and smaller slices. Your slice gets thinner.
A lot thinner.
They are actively expanding the total share count, which means any future profits the company makes are divided by a much larger number of shares, which actively reduces the earnings per share. Companies usually only resort to ATM programs when they are desperate. They need to raise cash to fund their daily operations, or in this case, to serve as a heavy debt load.
And to be fair, during this specific quarter, they actually did utilize the program. The CFO was transparent about it.
And did they?
He noted they sold a total of 6.8 million new shares onto the market at an average price of $6.54 per share. That raised about $44.6 million in gross cash proceeds.
Ah, okay.
That cash injection, combined with the free cash flow generated by the actual business, is exactly what gave them the firepower to pay down that $41 million in debt. So the dilution served a strategic purpose. It solved the immediate balance sheet crisis.
But the massive headline-worthy news here is that because their operational performance and their debt leverage profile have improved so drastically in such a short amount of time, they don't need the crutch anymore. They abruptly terminated the program entirely.
The exact quote from the CFO on the call was, "We believe our current liquidity and balance sheet strength eliminates the need for this funding source as a component of our long-term capital management strategy."
Let me translate that from CFO speak into plain English for the retail investor. We are finally making so much cash on our own, we don't need to water down your stock anymore.
Exactly.
No more stock dilution for current shareholders. The total share count is now capped, the debt is rapidly shrinking, and the underlying operational profits are soaring by 76%. You could almost hear the collective sigh of relief from the institutional analysts on the call when that was announced.
All of this analysis raises the ultimate question, though, for the retail investor who is looking at their brokerage account right now.
That's right.
We have spent the whole time unpacking a mountain of data. We've talked about the 900 basis points of margin expansion, the geographic diversification of the international growth, the verifiable AI-driven OPEX reductions, the massive disruptive potential of SingleTap bypassing the App Store monopolies, the incredible operating leverage, the debt reduction from 5 turns to 3, and the complete end of shareholder dilution.
It's a lot.
Taking all of this complex data into account, what is the actionable takeaway here? Where does this leave us on the Digital Turbine investment thesis?
This is the part of the deep dive where we synthesize the data and take an opinionated, actionable stance. And based on everything we have unpacked today, looking at both the historical performance and the forward-looking guidance, the bottom line is extremely bullish.
I have to agree with you. When you look at the broader landscape of the technology sector right now, what specifically stands out to you as the strongest pillar of that bullish thesis?
For me, the deciding factor is that they are definitively taking market share in an incredibly tough, highly competitive macroeconomic environment.
That's a great point.
During the Q&A portion of the call, an analyst asked a pointed question about the competitive landscape, specifically referencing the massive trillion-dollar ad tech behemoths like Meta and Google.
The giants.
And the CEO, Bill Stone, pointed out a very stark, undeniable contrast. He noted that the overall ad tech market grew in the mid to high single digits in the December quarter. It's sluggish.
Very sluggish.
But Digital Turbine's app growth platform, their AGP segment, grew by 19%, practically 20% year over year. They are growing at roughly twice the rate of the broader market baseline.
Wow.
You do not achieve that by accident. You do not achieve that by riding macroeconomic tailwinds. You do that by having a demonstrably superior product, vastly better targeting algorithms, and unique, frictionless technologies like SingleTap that advertisers are flocking to simply because it actually works better than the legacy alternatives.
That is a critical point. In the ad tech industry, advertising dollars are notoriously fickle and highly analytical. Brands don't care about loyalty. They care about math. Advertising budgets flow immediately and ruthlessly to whatever platform provides the highest return on ad spend, or ROAS. The fact that Digital Turbine's AGP revenue is surging by nearly 20% means that global advertisers are seeing real, measurable, superior conversion results on the Digital Turbine platform, which is compelling them to shift their ad spend away from competitors and toward APPS.
That's undeniable momentum.
Furthermore, the CEO mentioned a structural change. They reorganized their internal sales teams to focus on specific industry verticals like consumer packaged goods, retail, telecom, and broader tech.
Okay, smart.
By specializing their sales approach, they are seeing increased spend across the board. He specifically noted that the retail vertical alone saw 5x growth compared to the last holiday season. That is staggering, quantifiable momentum.
And when you pair that accelerating top-line momentum with the new reality of the balance sheet, the investment case becomes incredibly compelling. A year ago, investing in APPS felt like trying to catch a falling knife.
Oh, for sure.
The debt load was dangerously high, the operating margins were under severe pressure, and the broader macro environment for ad tech was absolutely brutal. But today, the narrative has entirely flipped.
It really has.
The balance sheet is suddenly much cleaner. The existential debt risks are fading fast. They've permanently shut off the dilution machine. For anyone currently holding the stock or considering initiating a position, Digital Turbine is proving they can grow the top line while radically sustainably expanding profitability.
Which is an incredibly rare and valuable combination in the technology sector right now. Most companies in the software space are trapped in a binary choice. They are either sacrificing all of their profit margins to buy top-line growth, or they are slashing their costs to the bone and accepting zero top-line growth just to survive the winter.
Right.
Digital Turbine is successfully threading the needle, achieving both simultaneously. And they are doing it while strategically diversifying their revenue streams globally, so they aren't completely dependent on a saturated US market or a single gaming genre.
Okay, we are going to wrap this up because I know we have thrown an absolute masterclass of financial data and technological mechanics at you today. But before we sign off, I want to leave you with one final, broader implication to mull over.
Let's hear it.
We talked extensively about SingleTap. We walked through the user journey, the elimination of friction, and how it is actively being used by 3 of the largest global game developers for dual downloads, allowing them to completely bypass the traditional Apple and Google app stores.
Right. And if you step back and connect this specific technology to the macro level shifts happening in the global economy, this is where the story gets truly massive.
It really does.
For over a decade, Apple and Google have operated as the undisputed toll collectors of the mobile internet. They built the digital highways, and they ruthlessly demanded a 30% cut of every single transaction that moved across them. It has created a multi-billion-dollar friction point that every developer on Earth deeply resents. Today, governments in the European Union and the United States are spending millions of dollars in legal fees, engaging in massive antitrust litigation, trying to break this duopoly through sheer regulatory force.
But here's the provocative thought I want you to take away. While the lawyers are fighting in courtrooms and regulators are drafting legislation, Digital Turbine might have just quietly built the technological bypass road.
Yes.
If their SingleTap dual download technology successfully and consistently enables the world's largest game publishers to effortlessly bypass those 30% App Store fees while simultaneously providing a seamless one-tap experience for the end user, well, Digital Turbine might not just be an ad tech company anymore.
Exactly. They are quietly positioning themselves to be the hidden, indispensable plumbing for a completely decentralized, multi-billion-dollar alternative mobile app economy.
That's huge.
They aren't trying to build a flashy rival destination app store that you have to spend billions in marketing to convince users to visit. They are doing something much smarter. They are just embedding the distribution directly into the ads and the firmware of the devices themselves.
Right.
It is a brilliant, highly disruptive Trojan horse strategy. They are already inside the gates.
And if that strategy plays out exactly the way management thinks it will, the $500 billion total addressable market opportunity that the CEO mentioned on the call might actually turn out to be a conservative estimate.
Easily.
So, as you look at your portfolio and navigate the market, keep looking past the Wall Street jargon. When a company CEO talks about AI, don't just buy the hype. Look for the verifiable proof in the OpEx line.
Always check the numbers.
When a company talks about growth, look at the margin expansion to ensure it's actually profitable. Stay focused on the underlying numbers that actually drive the stock over the long term, because underneath the hood, Digital Turbine is showing all the classic signs of a company whose engine has just been completely rebuilt for a new era.
When you look back at that duct-taped boat from the very beginning of our conversation, it is abundantly clear that Digital Turbine didn't just lazily patch the leaks to stay afloat. They stripped the entire business down to the hull, installed a massive, highly efficient new engine, and they're currently charting a course right past the traditional gatekeepers of the mobile economy.
And that is absolutely a journey worth paying attention to. Thanks for sticking with us for this extended deep dive into the APPS Q3 earnings transcript. Keep diving into the data, keep challenging the mainstream narratives, and we will see you on the next deep dive.